This is Daybreak Asia. We're counting down to Asia's major market opens. And Paul, we actually already started the week in Asia on a brighter note, but those moves on Wall Street overnight as well could inject a little bit more optimism into the session, even as we await some very, very key, crucial earnings.
Yeah, that's right. We had a pretty decent rally on Monday. Looks like that's set to continue today. But yeah, those big earnings announcements from Tesla. Later in the week, we'll have GM, Ford, among the other automakers as well. And of course, there's going to be a lot of US debt going to be auctioned this week also. We'll get to that in a moment. What are we keeping an eye on right now?
Yeah, that's right. Certainly going to be testing traders' appetite with yields hitting their highs for the year. But this is the open we've got for Japan and South Korea, Australia as well, coming online today. And at the start, as we said, we are watching for any further gains that we see in Japanese equities here that are, again, posting 1% to the upside for the Nikkei 225. It was that story of rebounding from last week's slump. And actually, we've seen the Nikkei 225 very close to entering a technical correction, but it moved off those levels. Of course, the Japanese yen in focus. Likewise, we're close to that 155 mark. So on the lookout, really, for any sort of government action to support the local currency. But, of course, given the BOJ expected to stay on hold later this week versus a still hawkish Fed, likely to stay weak for now. But that's the state of play there for Japan coming online. Let's shift and take a look at Korea's market as well, because yesterday we did see that Kospi rebound. Today, a little bit firmer as well. 4-week slump, so we're coming off the back of that. But the focus turning to earnings in this market. SK Hynix, one of the key ones to watch this week. Eco data to note as well, because we saw PPI rising 1.6% on the year, 0.2% on the month. But broadly, the takeaway from that is that domestic inflationary pressures are cooling in South Korea. And our Bloomberg intelligence team or economics team is saying that unless we see a further rise in oil prices, weakening domestic price pressures will probably keep CPI inflation on track toward the BOK's goal, the BOK not seeing cutting until the second half of the year, Paul.
Yeah, well, we've just opened for trade here in Australia as well. We do have a staggered open here, of course, but that notwithstanding, we are better by about 1/3 of 1% right now. We'll get a better idea of how things are tracking a little bit later on. The Aussie dollar showing a little bit more strength, now 64.5 cents US, but crude is an interesting one to watch as well. We started off the day with Brent parked exactly at $87, and it's moving a little bit higher now, and this is despite some of those tensions in the Middle East just easing off a little bit. We have, of course, just started trade in US debt as well, so let's see how Treasury yields are tracking. The 2-year backing off a little bit. It was knocking on the door of 5% yesterday. We've got a 10-year in the Japanese session right now, hovering around 4.6%. We are going to see, of course, a lot of debt being sold this week. The US selling $183 billion in 2-, 5-, and 7-year notes. So it'll be fun watching the market absorb all of that. Let's bring in Dorian Carroll now, head of multi-asset income at Schroders. And Dorian, I want to start with that point actually about yields. We've got the Fed, of course, looking higher for longer. Are you tempted to buy the front end here, especially with that 2-year so close to 5%?
Well, I think, thank you very much for having me on the show. And I think, we've been waiting for this to happen for some time. So we've been expecting the yields to move to back up, and expectations going forward to be that rates at these levels in the States are actually not that restrictive. So I think a short answer to your question is no, we wouldn't be buying the front end at the moment. But we are relieved, really, to see that it started to adjust to, we think, more rational expectations, because the US economy is doing extremely well at the moment. Employment is high. Projected GDP growth is very strong. So right now, we struggle to see the rationale for significant rate cuts in the States.
Yeah, what is your base case for easing now with inflation so sticky, the economy looking pretty strong? Are cuts in the US becoming more of a 2025 story now?
Well, yeah, I mean, we don't want to be too contentious on answering these kind of questions, but if you look out this year, it's moved from 6 cuts at the beginning of the year to June to July, potentially September, even perhaps a symbolic cut. And then as we go into next year, we've really got to reassess because the US economy has been very strong. It has been very resilient. And when you look at financing conditions, which are much more important for the corporate world, the yield curve is inverted, spreads are quite tight, and it's very possible for companies to term out their debt. So what we've noticed most is the cost of financing hasn't really gone up for corporates, and we think that's a key data point. So looking into next year, we're going to have to see what happens in November in the US elections, and some of the policies, frankly, on the fiscal front, in terms of taxes, potentially even in terms of immigration, don't look too great from a sort of disinflationary perspective.
Yeah, so you're watching that reinflationary risk, I guess. But how does the Fed move and that potential that we stay high for longer constrain central banks here in Asia?
Yeah, I mean, we tend to look at it quite differently. So we wrote a piece recently called The Power of Gravity, and it's referring to the idea that the Fed stays higher for longer, and that obviously affects all markets. I think most obviously the ECB. Christine Lagarde's been very, very clear that she wants to cut in short order, but we would say the scope, the extent of those cuts will be limited by the Fed. And similarly in Asia, obviously monetary policy from the Fed affects local debt markets across the world. So if the Fed stays higher, there needs to be a reassessment. And I think, perhaps a little bit more sort of from a longer term perspective, are rates really high at these levels is a question that we've been asking ourselves on the desk.
And what about the market in China? Because, of course, that's a very different environment for rates and a very different economic outlook right now.
Yeah, I mean, China's got a very different problem. It's definitely got a sort of deflationary pulse going through. Rate cuts and easing of conditions have been kind of the order of the day for some time now in China. But we are seeing, from a sort of perspective of looking back a few months when there was extreme pessimism, a bit more of an opportunity perhaps for a slight cyclical pickup in China. The long-term growth rates do look like they're coming down. But from a rate perspective, yes, it's a very different story there. But we do see a bit of a cyclical or a tactical window. And it's very important from a global growth perspective. The IMF have come out with upgraded forecasts for the US and elsewhere. And it's all looking a little bit better than it was before, but China is absolutely central to that.
It's going to be a big week for tech earnings, of course. We did see a bit of a pullback last week. When you see those dips, do you buy, or do you think some of these names are looking a bit keenly priced at the moment?
Yeah, that's the real sort of topic that's occupying a lot of us at the moment. I mean, I think, we're income investors, so, that's the first point to make. So typically we use growth to blend on a kind of barbell strategy. And I think where we've been a little bit more radical is incorporating a kind of benchmark weight to a lot of these mega cap tech names. You've got the earnings, as you say, coming through this week. The only comment we'd really make is that, yes, the multiples are high, but we do think that the projected growth rates are realistic. And that you can see them critically coming through. So, I mean, a lot of people have looked at mega cap tech as both growth and a little bit defensive, and it's that transparency on the earnings. And also, if you look at AI and you look at technology, the kind of budgets that they have to spend in these areas really put them in a very strong position going forward. So, I mean, we don't trade day to day. We don't have a strong opinion about who's going to hit and who's going to miss this week. But we do think these companies' growth rates justify a significant premium to the market.
The expectations are pretty sky high in terms of the earnings growth that we can expect here. If we don't meet that, or even if we come in line with it, where do you think the market goes next?
Yeah, I mean, I think you have to split the market up a little bit here. So, if you look at semiconductors, the expectations are stellar, and you have to split there the AI kind of driver and also the more sort of mundane part of semiconductors, which is doing less well, and you've seen that in some of the results that have come through. On megacap tech, they are very different companies, and it is strange that they've been bracketed together. So we think that selective names can do quite well, but generally their growth rates are not, too optimistic relative to their prospects, we think. What does it mean for the markets? If there's a big miss, clearly the markets have been a bit jittery over the last few weeks, combined with the fact that rates are higher than many people expected. So a big miss wouldn't be good. But, we think we're in an environment of broadening out here. So we've really been looking at Europe. We've been in Japan for some time. We've been looking at global energy, for example. So, if there's a miss, it could be an opportunity for this broadening out to carry on, which we think would be healthy. And we think finally that the pullback recently has been a healthy kind of pullback and reassessment for the market.
That was Dorian Carell there, head of multi-asset income at Schroders, and we're just pretty much 10 minutes into the session so far for Sydney, Seoul and Tokyo. And taking a look at some of the drop that we've got coming through for gold miners in particular, or gold-linked stocks. We did, of course, see bullion taking a little bit of a tumble overnight, and that's as investors sort of back away from some of the haven assets like gold, given that the risks in the Middle East of an all-out war in the region seem contained for now. So that's the state of play. As we said, gold very much in focus and trading below that 23.50 level an ounce. But the other group of stocks we're tracking, or stock in particular we're watching, is Woodside. That stock today also a watch for us in the Sydney session. Given some moves at the top of the business, but actually Woodside not trading as yet. But Paul, of course, the focus, actually we do see Woodside online and it's just a little bit weaker so far. But Paul, Macquarie Group as well coming up.
Yeah, that's right. Woodside does catch us out, starting with a W, does tend to start trading towards the ends of the morning. But Macquarie Group, as you mentioned, is going to be sharing their outlook with us on FX markets in a moment, and also why they're seeing further vulnerability for Asian currencies. First, though, ByteDance, well, it's digging in for a legal battle over US moves to force a TikTok sale. We're going to have more on the implications for Chinese and American businesses next. This is Bloomberg. TikTok's Chinese parent company ByteDance has made it clear that it has no intention of selling the short video app, and this is as the US government moves ahead with its threat to shut down the platform if it's not divested. For more, executive editor for Asia Technology, Peter Elstrom, joins us. So, Peter, ByteDance looks ready to play the long game here in terms of the legal battle. How does this play out, and is it waiting around, stalling for time for maybe a more favourable administration after November?
Yeah, that's exactly right. Things are moving pretty quickly in Washington right now. The House has gone ahead with legislation that would give ByteDance this ultimatum to either sell the TikTok operations in the United States or it would be banned in the country. The Senate is expected to pick up that legislation this week and also pass it, and then Joe Biden has said that he would sign it into law. So that is going to give ByteDance, the parent company of TikTok, this ultimatum that either they need to sell the operation to another buyer, a non-Chinese buyer, or it would face this shutdown in the United States. You'll recall that 4 years ago, it faced a similar kind of ultimatum, and it negotiated a preliminary deal to sell the U.S. operations to a very complicated deal that involved Microsoft and also Oracle. In this case, it's exactly the opposite. The company is not considering a sale. It's not working anything out. It's really not contemplating that option very seriously. And there are a few reasons for that. One, you're exactly right. They see that the elections in the United States are November. They know that changes in administration can change their fate and what the political outlook is for something like this. And also the business in the United States now is much, much bigger than it was 4 years ago. They have about 170 million users in the United States. They're also generating a lot of revenue from those users, primarily through advertising at this point. And they feel like they can probably take this to the courts. They can sue to stop the legislation. They can probably get a temporary stay. And then they can, as you say, they can play the long game and see whether they can wait this out.
And the long game, perhaps, Peter, could involve exiting the US market for a period. But can TikTok survive, given, as you said, the US is such a key market now?
Yeah, Annabelle, that's a very good question. ByteDance, I think they look at it this way, that if they sell the U.S. operations to somebody else, they lose that forever. Whereas if they shutter the operations or they try to fight it in court, they have an opportunity to be able to regain their position in the U.S. market, where, as you said, they become quite successful. They can continue to run all of their other operations within the world. Outside of China, TikTok is very, very popular. The United States is the biggest market, but they'd be able to continue in those other markets. Many U.S. users may figure out ways around the ban to try to use VPNs or other devices to be able to use that option. Could they come back into the market? It's very unclear whether that would be a viable strategy over the long term. Of course, the tech industry moves very, very quickly. You're also talking about a combination of influencers who create content for the platform and advertisers who advertise alongside those influencers. If that contingent, if those two sides of that business begin to shift to other platforms, that would create kind of long-term problems for them. So they are taking a fair number of risks here.
That was our executive editor for Asia Technology, Peter Elstrom there. And let's keep on the TikTok story, bringing our Greater China senior executive editor, John Liu, still in Hong Kong for us. And John, Beijing is a really big hurdle here as well. I mean, we know that Beijing wants to see homegrown tech giants succeed overseas. So how likely are they to block any sort of divestment of TikTok, given it does need the approval of regulators in China?
I think the likelihood of Beijing stepping in to block a sale of block TikTok from selling its America business, I think, is relatively high. And I think the rationale is, I mean, there's a lot of politics in the U.S. There are also a lot of politics in China, slightly different. But I think the government is going to be keen to not look like it's being pushed around. It's going to be keen to look like it's defending Chinese companies. And so I think some of that consideration will push Beijing to act. Whether or not they will, I think we have to wait. But there was a law passed that any high-end technology exported outside of China, including the algorithms used by TikTok, that has to seek approval from the Chinese government. So I think they will have an opportunity to block it if they want. And I think the likelihood that they would decide to do that is relatively high.
Mm-hmm.
John, I want to talk about another policy in China as well to do with stimulating demand and particularly encouraging consumers to upgrade old equipment. That includes electric vehicles. What's the plan here and what's it going to cost?
So the plan is that the government is going to offer subsidies, incentives to buyers to compel people, if they have an older gas car, to trade that in for an electric vehicle. The government is also going to do that when it comes to home appliances. They're going to do similar things when it comes to equipment used in factories. This is all part and parcel of an effort to try to get consumption up and moving again. That has been the big question for this economy. Where is the end demand going to come from? There's also been a lot of concern expressed by people like Secretary Janet Yellen when she visited China, the German Chancellor when he visited last week, that what China will do to seek that end demand will be to export in great amounts to other markets. And so if China can get its own consumers out and spending, that would help to alleviate some of that concern and pressure.
Yeah, do you think it's going to be enough to alleviate these tensions that we're seeing around China exporting its supply glut to the places like Europe and the US in those key sectors like EVs or renewable energy, for instance? I
think it'll all come down to how much the government is willing to spend. And that's a detail that we do not have yet. I think there was some Goldman Sachs estimates that for electric cars, it'd be somewhere in the neighborhood of 380 billion yuan. That's about 50 billion US dollars. Mm-hmm. Something of that scale potentially could do a lot in terms of alleviating a lack of demand. But whether or not the government has the financial capacity to step up, that's another question we have to wait and answer.
All right, Greater China Senior
Greater China.
Executive Editor John Liu there. All right. Thanks, John. We've got plenty more to come on Daybreak Asia. This is Bloomberg. Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital over the last year or two. Both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if the time was there, sure, we could go public.
Okay, let's check in on shares in Woodside at the moment. Having a pretty good morning, actually, up by 0.4%. The stock has been off by about 7.4% year to date, but it's up today. We've seen a modest uptick in the oil price as well today, of course, but this is on signs that there might be a bit of investor discontent around Woodside Energy at the moment. One of Australia's largest pension funds has voted against the company's climate plan and the re-election of its chair, Richard Goyder. So for more superannuation and pension funds correspondent Amy Bainbridge joins us now from Melbourne. So Amy, what's going on ahead of Woodside's AGM? It's happening on Wednesday.
Well, certainly, Paul, sometimes the superannuation funds, as we call them here in Australia, don't like to talk too much about how they're going to vote ahead of a major meeting such as the one tomorrow. But in this case, there's been quite a bit of noise leading up to the annual general meeting. Aware Super, which has 170 billion Australian dollars under management yesterday, told Bloomberg that they had voted against the re-election of Mr Goyder and also against the company's climate transition plan. They said that there just hadn't been sufficient progress made on climate change in the company for it to support both of those motions being put to the meeting going forward. And those votes are put through electronically ahead of the meeting. There's already a deadline passed for those votes. Also yesterday, Australian Super, which is the nation's largest pension fund with more than 330 billion Australian dollars under management, said that they had also voted against the climate plan of Woodside but had supported Richard Goyder's re-election. And there's been various other funds that have been making comments in the lead up to this event, including Hester, another large fund, which has confirmed that it has been putting to Woodside some alternative board member proposals to see whether the company can do more through its leadership to transition and reduce its emissions.
So, Amy, how much power do pension funds have here?
It's a great question, Annabelle, because it seems that they have quite a lot, but it's not always obvious when you look through the data. But what we do know is a lot of these funds have holdings through index providers as well. Australian Super, for example, holds about 3% of Woodside. They said yesterday at a greenwashing hearing at Parliament in Canberra that was largely inherited through the merger with BHP. So now they are really trying to advocate for a better climate transition for that company. Aware Super, they hold just over 1% of the company as well. But collectively, there's been a national body called the Australian Council of Superannuation Investors, which represents investors of around $2 trillion worth. And they had also put forward a proposal to its members recommending that they vote against Woodside's climate transition plan, although they did stop short of saying that Mr Goyder should not be re-elected to his position as chair. So it would seem now also worth mentioning that the funds here, the pension funds, are under enormous pressure to back up their climate statements that they're making, their net zero targets, with action. So many of them have been a little more forward in their commentary in the lead up to this meeting.
That was our superannuation and pension funds correspondent Amy Bainbridge there. We'll get the latest corporate stories we're tracking as well. And the US Federal Trade Commission is seeking to stop an $8.5 billion merger between two fashion giants. The agency filed complaints alleging that the deal between Coach parent company Tapestry and Michael Kors owner Capri would harm the luxury goods market. This is the first time that the Biden administration used its aggressive antitrust enforcement to try to stop a deal in the sector. Reliance Industries disappointed on profit for the fourth straight quarter, hampered by continued weakness in its petrochemicals business and higher taxes. India's largest company by market value reported a dip in profit to $2.3 billion from year-ago levels, while revenue did top expectations. In an earnings call, the Reliance CFO said the business faces a multi-decade low in petrochemicals. Coming up, hear why Macquarie Group is anticipating further vulnerability for Asian currencies. Its macro and FX strategist joins us next. This is Bloomberg. This is Daybreak Asia, just taking a look at some data points coming out. This is the Jibun Bank Japan PMI figures. Manufacturing, we're seeing an improvement from the prior reading, coming in at 49.9, so very close to that 50 threshold that's seen as expansionary. Composite reading as well, an improvement here, so 52.6, the prior reading 51.7, and services, little change from the month prior, but 54.6, it was 54.1. in the March reading. These are the preliminary figures for April, of course, but it does tell us that story that manufacturing sentiment is improving or continuing to improve in Japan. What you're seeing there in terms of the dollar-yen trade, it's fairly steady right now. We have seen that Japanese yen holding very close to that 155 mark. It's really that story of the yield differential between the BOJ and the Fed, unlikely to be improved this week given the BOJ very much expected to stay on hold. But let's shift now, take a look at Asian FX more broadly. In the session today so far, what we're seeing is little movement. The dollar gauge fairly flat right now. But the story of this year so far for the dollar is that it's just a force that we really didn't bet on. A strong dollar is back, and it very much looks set to stay. So let's discuss with our next guest, who says vulnerability for Asian currencies is increasing. With us now is Trang Thuy-Le, macro and FX strategist at Macquarie Group. And Trang, perhaps something we didn't expect coming into this year was just the greenback being so strong.
Yes, exactly, and thanks for having me on the show. I think for this year, the strength of U.S. economy continues to beat expectations. And so at the start of the year, when the market was able to price in aggressive Fed cuts, we've now down to more than 1.5 cuts only. And our view is that we would only have one cut this year in December. And that means that, U.S. yields, as you said, going to be higher for longer. And that means for dollar Asia, we continues to be in a very challenging environment.
And is that a trend that you think will worsen perhaps going into the second half? What's your outlook?
Well, I think for right now, where we are in second quarter, it's a very vulnerable period. And the reason I said that is because second quarter typically see a very negative FX flow. So quite a number of Asia countries, including India, Indonesia, and Thailand, have negative current account seasonality this quarter. And when you throw in the backdrop of hawkish Fed, geopolitical risk, and potentially another increase in the dollar CNY fixing over the coming period, I think that really means that you may not have seen the worst, and things may get worse before it gets better.
Yeah, let's talk a little bit more about that fixing. How far do you think the PBOC might be willing to let the yuan depreciate, and what could be the knock-on effects of that?
Yeah, so it's been a key question this year. I think really the RMB holds the key to how bad Asia sentiment would get. If we have the PBOC holding the fix largely steady around current level like 710, I think that would help Asia central banks. But unfortunately, we think a move higher in the fix is more likely. And the reason for it is that if you look at the China basket, the CFETs, it has gone up about 3.4% year to date. So I think that provides a policy room for the PBOC to raise dollar CNY without compromising its FX stability mandate, in the sense that they could always measure it against a broader basket. So my view is we get the dollar CNY fixed to about 714 in second quarter, and with that move, then dollar CNH could touch 730. So that's the level that I think once it filters through the rest of Asia, it could cause another leg of Asia FX sell-off.
Yeah, that's an interesting point you make, because so much of the focus is usually on the yuan US dollar. But to your point, we have a chart on the Bloomberg terminal that illustrates this. The yuan versus the basket of peers, it's the highest it's been in about 17 months. As pretty much all of Asia weakens against the US dollar. So going forward, how do you see the yuan performing against its regional peers?
Yeah, so I think there would be some downside to the CFET's basket when the PBOC start to raise dollar CNY fix more meaningfully in the direction we predict. However, it will not see aggressive downside to CFETs, because at the end of the day, in a strong dollar environment, dollar RMB tends to inch in the same direction as well. Having said that, I think the fact that China economy recovery is still slow, they still rely a lot on exports. So I think that means that they would prefer a somewhat weaker currency level from here, definitely against the basket.
What about the moves that we're seeing in the oil space? Because, of course, it's been that story of resurgent oil on the back of Middle East risks. Those do appear contained for now, but there's still a chance that oil does move higher. So how is that going to also affect the dynamic?
Yeah, so I think it's quite interesting because across EM Asia, we have some net energy exporter, energy and gas exporter, like, for example, Malaysia ringgit. However, when you see oil move higher on the back of supply shock, like what we are seeing recently, then across EM Asia, dollar Asia just move a lot higher. And I think it reflects the concerns around inflation filter through to our region. But more importantly, it also a reflection of the fact that the dollar itself is an important petrol currency. And so when oil price strengthen on the back of supply shock like this, the market feels that Fed can get more hawkish. And on the back of that, US yields rise, and that filter through and move dollar Asia broadly higher, regardless of whether you are net oil importers or exporters.
Yeah, we do have the ringgit starting to approach that 26-year low, but I want to talk about Malaysia's neighbour, Indonesia, as well. We've got a Bank of Indonesia decision coming up on Wednesday. Intervention hasn't really done much to halt the slide in the rupiah. Do you expect Bank Indonesia is going to do something to put a floor under the currency?
Well, I think they definitely will try. I guess, at the start when I say it's hard for us to say with confidence that the worst is over for dollar Asia. However, at the same time, I would say when it comes to the rupiah, what we can say is that the pace of the sell-off from here will probably slow because of increased Bank Indonesia resistance. I think this week meeting is definitely live. And not only would they decide whether to hike or not, I think they would go a step further to discuss discuss, whether 25 basis point would be enough or they would have to do more. My base case is that they settle with a 25 basis point hike to the policy rate. However, at the same time, they are likely to jack up the SRBI yields as well, so de facto tightening liquidity on that front. So I think the combinations of interventions, interest rate highs would help to slow the rupiah decline. But as you said, the deciding factor for us is really the direction of the dollar and commodity prices. And right now, I think we still need to be in that wait-and-see mode.
All right, Trang Thuy Le, for macro and FX strategist at Macquarie Group. Thanks so much for joining us. Okay, let's take a look at how markets are tracking here in the Asia Pacific. It's looking like another reasonable day for equities at the moment. Here in Australia, we're better by about 0.6%. And if we take a look at how the market is performing by sector, the rally for a second day, pretty broad-based. It's really only utilities and industrials that are suffering here. Elsewhere, we've got the Nikkei having another good day, better by 0.5%. The Kospi following on from yesterday's gains as well, with another modest rise. And of course, this follows on from a pretty decent day for US stocks as well. Let's take a look at how we're doing in the commodity space also. Even though we've seen tensions easing in the Middle East, we do have Brent rising. It started off the day at $87 even, and now we're up at $87.41. New York crude rising as well. A bit of focus on gold today as well. That rally holding on by its fingernails at the moment, but that is our Bloomberg question of the day, in fact, whether or not gold is in a correction and we're done, or whether or not there's another leg higher to go. Some of our guests today think that maybe gold could pull back below that $2,300 an ounce level. Bell.
Yeah, Paul, it's really just perhaps it comes down to what we see in the Middle East and whether those risks of an all-out war are contained. They do appear to be for now, and that's really playing out the dynamic as well. But certainly the geopolitical stories we're tracking this morning, the Israeli military intelligence chief has quit for failing to prevent the October 7 invasion by Hamas. Aharon Haliva is the first senior Israeli official to step down over the assault that killed around 1,200 people. He accepted blame shortly after the Hamas attacks, but stayed in his role as Israel launched its war in Gaza. The EU has agreed to impose new sanctions on Iran over its attack on Israel. The deal will further expand restrictions already imposed for supplying Russia with drones. The measures also target weapons transfers to Iranian proxies in the Middle East, including Hezbollah. Countries including Germany and Sweden are pushing to add Iran's Islamic Revolutionary Guard Corps to the EU's terrorism list. President Biden has told his Ukrainian counterpart that the US will move quickly to deliver weapons if the Senate votes this week to approve an aid package. In a phone call, Biden told Volodymyr Zelensky the US aims to swiftly ship the battlefield and air defense equipment. Meanwhile, the UK is sending more missiles to Ukraine, including long-range guided weapons, in a package worth $620 million. And remember that Bloomberg users can interact with the charts shown using GTV Go. You can browse recent charts featured on Bloomberg TV to catch up on key analysis and as well save charts for future reference. This is Bloomberg. Bloomberg's learned that over a dozen Japan rates traders have left banks for hedge funds. That's amid bets that the BOJ's move to unwind stimulus will create a volatility-fueled boom. For more, let's bring in our Asia investing reporter Lisa Du in Tokyo. And this is one of the really interesting sort of knock-on effects of Japan moving toward policy normalization. But certainly this is something that could really reshape the market as well.
Yes, certainly. If you are a rates trader in Japan these days, you're probably very busy with both work and taking calls from headhunters and recruiters that want to hire you away. Like you mentioned, we've identified more than a dozen traders that in the past year or so have shifted from Wall Street banks like Morgan Stanley and Citigroup, as well as Japanese mega banks, and moved on to work at hedge funds that are all trying to get a piece of the action in Japan. Like you said, the Bank of Japan for years had this yield curve control policy as part of a stimulus that really put a lid on government bond yields. Now that they've done away with that policy earlier this year, it's created this volatility that funds can trade and make money off of. Some of the funds we've identified being very active in hiring are Millennium, Blue Crest, and Capella here in Japan.
So anecdotally, I mean, what are we hearing from people who are trying to hire traders? Is there a shortage of staff, and what's it meaning for salaries?
Yes, the competitive landscape here is it's very competitive here because the talent pool is very, very limited. Because of the BOJ's yield curve control, this has really been a very sleepy corner of the financial markets here in Japan. And it was very basically the talent pipeline is very limited. So some headhunters and recruiters estimate that there's probably less than 100 of these traders at big banks that funds can hire, and probably an even smaller portion of them would have that risk appetite to want to shift from a very stable job at a mega bank or a big bank to work at a hedge fund. Of course, because this is a financial industry we're talking about, they are not being shy about dangling incentives. We've heard that many banks are really boosting bonuses for their traders, even though it's not been a great year for them. But at the same time, on the hedge fund side, they do guarantee a much bigger payout of the profits you make for them. So basically, this is going to be a very active hiring space going forward for people to watch.
Yeah, just crunch the numbers for us. How much more can you get from a hedge fund in terms of profit sharing, for instance?
Yeah, I mean, the numbers really vary, but kind of the headline number that headhunters like to reference is that basically you're a trader at a bank, you're usually taking home about 3% of the profits you make, but alternatively, compared to a hedge fund, you're probably taking 20% or more of the profits you make. So the difference in salary is substantial.
All right, Asia investing reporter Lisa Du there in Tokyo. Here are some of the latest corporate stories that we're following. Chinese wealth manager Noah Holdings is planning to beef up the number of managers it has in Hong Kong and Singapore. The company's chief financial officer says it wants to have about 150 to 200 managers in the financial hubs by the end of the year, and that is up from the current 100. The private bank is expanding overseas as China's rich look to diversify their wealth. Japan's Fair Trade Commission says Google used tactics that limited Yahoo Japan's ability to compete in targeted search ads. The antitrust regulator says the company blocked Yahoo Japan from accessing technology needed to receive targeted ad revenue from searches on mobile devices between the years of 2015 and 2022. The FTC says Google changed its conduct as soon as they flagged the practice and has promised to give Yahoo Japan access to the tech. Saudi Aramco has started talks to buy a 10% stake in China's Hangli Petrochemical. The state-owned company has signed an initial agreement to explore a potential transaction. No financial details or a timeline were provided. Aramco is seeking more deals in Asia to expand its business and secure long-term buyers for its crude. The Singapore Exchange is proposing a rule change to make it easier for some shareholders to call special general meetings. Under the proposal, companies must take steps within 3 weeks to hold a meeting if shareholders with at least 10% of paid-up stock call for one. This is the latest move in an ongoing push to improve corporate governance in Singapore in response to rising shareholder activism. Still to come, bubble tea maker Cha Baidu is Hong Kong's biggest IPO offering this year. We're going to preview their debut up next. This is Bloomberg.
Taking a quick look at futures here, you've got US stocks fairly steady right now, but the open in Taiwan just about 10 minutes away and pointing to some gains there. China futures also looking a little bit firmer here. Something to note is we actually just had UBS pushing through an upgrade for China and Hong Kong equities to overweight. They've actually downgraded Taiwan and Korea stocks to neutral. So a bit of a shift in sentiment here where we are just starting to see green shoots. Investors are coming back into mainland stocks. But let's take a look at what's going to be a pretty big test as well for Hong Kong today because it's been a very thin IPO market, not a great timeline or outlook really, but the bubble tea maker known as Chai Bao Dao has declined in grey market trading ahead of its debut on the Hong Kong Stock Exchange. For more, let's bring in equity capital markets reporter Felipe Pacheco. And Felipe, just talk us through the background for this IPO, but also what we're going to expect at the open, because as we said, grey market trading, it's not looking too pretty.
That's right. Well, it should be a very interesting start today. This is the biggest IPO in Hong Kong since November, but we're still talking about $330 million US dollars. As you mentioned, this is a very thin IPO market at this moment. This IPO was quite peculiar because it was flagged for a while. The company decided to come to market with a deal that's actually smaller than initially expected back in time, but it went through, and they managed to go all the way through closing the books. But there was not a price range, so there was always with a fixed price of $17.50. That's the level that the stock is starting today. But as you mentioned, great market yesterday was a great indication of what we should see as soon as the stock starts trading, and the performance was not good. It was down. The shares were down over 13%, so it wouldn't be surprising to see some pressure as soon as the stock starts trading in half an hour or so.
Felipe, even though there seems to be a bit of a lack of enthusiasm among grey market traders, is it possible we'll see some more bubble tea companies coming to the market? How's the pipeline looking?
Paul, it's very fair to say that a lot of companies will be looking at this IPO, not just because of the size. It's quite meaningful considering the context in Hong Kong right now. It wouldn't be the case 2 years ago, but nowadays $300 million US dollars is quite a significant amount. And of course, you have competitors. You have other tea bubble companies that are looking at the Hong Kong market that have started the process to actually sell their shares. We're talking about Mixway Group that's been out there talking to banks for a while now. There's another company called Sexy Tea, which is actually expecting to list their shares here in Hong Kong as well. So we do have competitors, and we have the broader potential Chinese companies that are expecting to list in Hong Kong that will be checking the performance. As of now, it's very hard to say that whether we'll have a positive day or not.
Yeah, and I'm very curious about selling shares at $17.50 a piece, Hong Kong dollars. Is that something we typically see where we don't get a marketed range? And what would be the lesson from that for other companies that are looking to list here possibly?
That's a very good point, Val, because usually we do have a range. And sometimes when the market is not good, if they price at the bottom of the range or even below, which is rare, but it can happen, it's a very negative indication of sentiment and appetite overall. When you come with a fixed price, it's easier for you to actually crave what's the valuation that the company is seeking, and then what bankers should be quite confident that they would be able to get to that point, probably after having a lot of conversation, a lot of chats with investors and with the company willing to come at that market value. When you have the range, if you actually sell at the top and then you have a pop after the debut, that's a very good indication. There is appetite, there is demand. Well, the opposite, when you come at a very confident price level and then you have a very sharp decline, it's an indication of pessimism for sure.
All right, all about the price discovery. That was our equity capital markets reporter, Felipe Pacheco, there ahead of what is going to be a key test for Hong Kong's IPO market later this morning. But time to check on some of the stocks to watch. Of course, when markets do open in Hong Kong and mainland China here, we're going to be keeping an eye on Asian Tesla supplies. Of course, the EV maker set to report its first quarter results. That's after cutting the price of its cars in key markets, including China. We have seen that slide for Tesla down more than 40% this year. Asian miners as well, they may move as gold takes a tumble. Haven demand easing with tensions in the Middle East also appearing to be a little bit contained for now. what we're seeing in the broader markets so far, just about an hour into the session, and it's looking fairly mixed at this point in time. Not really seeing outsized moves. So it does perhaps point to the number of tests we've got ahead. We've got a number of key bond auctions that are coming up, set to test investor appetite, and also key earnings that are on the docket as well. We mentioned Tesla, but there's a number of so-called Magnificent Seven names that are due to report. So we'll get more on that, of course, these different themes coming up in the next hour. Saxo's chief China strategist tells us how the upcoming US election is shaping up mainland equities and the yuan, of course. That is it from Daybreak Asia. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.